Hello friends, welcome to Learning with Z. This is the third video in the series of financial ratio analysis. The topic that would be covered in this ratio is profitability ratios. Profitability ratios are of interest for everyone because it analyzes and measures the overall efficiency and performance of the firm. It assesses the income generation capacity or the business operation success of the firm at various stages of profits. It helps the investors to assess the operational health of the firm and thus the growth potential of the firm to invest in future. Profitability ratios are categorized into two categories. One, sales related ratios that are called margins, and another is investment related ratios that are called returns. Whereas margin ratios looks at profits as a function of sales at various stages, returns looks at the overall efficiency of the firm in generating returns for its shareholders. Let us look at the sales related profitability ratios first. The first one is gross profit margin. Gross profit margin is the ratio of gross profit earned by the firm in a year divided by sales of that year. It's multiplied by 100 to give the percentage. Gross profit margin indicates how efficiently the firm manages its COGS, that is, cost of goods sold, which includes raw material, labor, and other manufacturing expenses. This metric is very important as it reveals how much is remaining with the firm after paying for its operating costs, that is, its labor cost, raw material cost, and manufacturing cost, and how much is left to meet other non-operating expenses and for future savings. The higher the gross profit margin, the better it is. Let's take an example. If the gross profit margin for a company is, let's say, 50%, then it means that for every dollar of sale that is done by the company, it makes 50% as gross profit, which is available for future savings and for meeting other non-operating expenses. The second sales-related profitability ratio is operating profit margin. This is calculated as earnings before interest and tax divided by sales of that year multiplied by 100. This ratio is also very important. It assesses the ability of the firm to generate profits after paying for other non-operating expenses. This measure considers profit from core business activities, so it reflects the operational efficiency of the firm and its long-term growth potential. Again, higher is the operating profit margin, the better it is for the firm. If the operating profit margin is, let's say, 12%, then it means that for every $1 of sales generated by the firm, it makes 12 cents as operating profit, which is before paying interest and taxes. Operating profit margin is considered as a better ratio of profitability because it considers profits only from core operations of the business and excludes the non-core. Hence, it reflects the long-term prosperity for the company. The third important sales-related profitability ratio is net profit margin, which is calculated as profit after tax divided by sales. This ratio provides a final picture of profits earned by the firm. Since this is the final profit earned by the firm, it means how every dollar is translated into net profits which is available to the shareholders. This ratio is of significance to everyone, including investors, lenders, analysts. Higher the net profit margin is, the better it is for the firm. This ratio is often used for inter-firm comparison. It indicates how effectively the firm controls its cost, pricing, carries out its marketing activities, and manages its non-operating expenses. A lower net profit margin often indicates a decline in the sales for the company and represents financial risk, especially in cases where the firm has a lot of debt on its balance sheet. Cash flow margin ratio is yet another sales-related profitability ratio which is of great importance. It looks at cash flow from operating activities divided by sales of that year. Cash flow margin indicates actual transfer of money, that is, it excludes the non-cash expenses like depreciation. Hence, it is preferred over net profit margin ratio by lenders and creditors especially. It indicates working capital efficiency of the firm. This means how effective the firm is in the short term to meet its liquidity requirements. As it shows the cash flow picture for the firm, it gives a better idea to the investors on how strong the company is in managing its risk, especially liquidity risk, and in managing the growth potential and its borrowing capacity. The last in the sales related profitability ratio is operating ratio. It is calculated as total operating cost divided by sales. Operating ratio analyzes the profitability of the firm with regard to coverage of expenses. Unlike the other profitability ratio, this ratio should be as low as possible. The lower the ratio, the greater it is for the organization's ability to generate profits, especially when its revenues or sales are declining. Let us look at the investment-related profitability ratios now. The first one is ROTA, also known as return on total asset. This is calculated by EBIT or earnings before interest and taxes divided by total assets. ROTA is an important ratio. It indicates the efficiency of the business in using its assets to generate revenues. The business is said to be more efficient in using its assets to generate revenues if its ROTA is higher. It is an important metric which is often used for inter-firm comparison. The company with a higher ROTA is said to be most efficient in using its asset to generate revenues than the other. The second investment-related profitability ratio is ROCE, also known as return on capital employed. This is calculated by dividing EBIT to capital employed. This ratio is also very important because it measures how efficiently the company uses its capital employed for its business operations. That means, how is every dollar of capital employed is used to generate profits. As it includes long-term financing, which is a mix of equity and debt, it reflects long-term profitability for the firm. It also indicates how the company is efficient in making decisions for long-term growth. Between firms, a company with an increasing ROE figures is considered to be growing as compared to companies where ROE figures are either declining or remaining constant. So friends, I hope you have found this video useful in understanding and interpreting the profitability ratios. Stay tuned to my channel for the upcoming video on efficiency ratios. Thanks for watching and bye for now.